Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, October 24th. Equities in Europe and the US have been under pressure for the first three trading sessions of this week, and that was obviously on the back of US political and Middle East geopolitical uncertainties, and also this mounting expectation that the US Federal Reserve should, eventually take it easy with its interest rate cuts due to strong economic and corporate data in the US. And indeed, Tesla just joined the crowd of US companies that announced better than expected earnings last quarter. So the first three sessions of this trading week haven't been glorious, to say the least, as the US political uncertainties, the ongoing geopolitical jitters in the Middle East, the expectation and the speculation about what the US Federal Reserve should do next, given that we have strong economic and corporate data in hand right now after its last 50 basis point cut, and also the incoming earnings from both sides of the Atlantic Ocean throw a big amount of information to investors who actually prefer moving toward gold these days and sitting there. So the yellow metal runs from record to record, and that despite the rising US yields these days, which in return rise not only because of the weakening dovishness regarding the Federal Reserve's rate cut bets, but also because of a general lack of appetite before the upcoming US presidential election due on November 5th. And a quick word though, the US is expected to expand its national debt, and that no matter who sits next in the White House. Now, some investors say that having Donald Trump back there would be bad for US stock appetite, which in my honest opinion wouldn't last long if that happens. But one area where we could actually really see the difference between Harris and Donald Trump is international trade, because if Trump comes back to office, we could see the tariffs on Chinese and European goods explode, and that would be inflationary for the US and quite miserable for the rest of the world. In fact, the IMF lowered its global growth forecast for next year to 3.2% due to accelerating risk from wars to protectionism. It, however, left its 2024 projection unchanged for inflation and expects inflation to slow to 4.3% in 2025 from 5.8% this year. But anyway, even though we can only wait and see how the US elections will result, and if and how strongly Israel will hit Iran, we can already collect some insightful information regarding what's cooking in the Federal Reserve's kitchen for the November and December policy meetings. In this context, the Fed's Mary Daly said that she hasn't seen any information that would suggest that they shouldn't continue cutting the interest rates in the US. But other Fed members who appear to be better informed than Mary Daly about the latest economic data, like Neil Kashkari, for example, say that the interest rate cuts in the US should continue, but at a moderate speed. So activity on Fed funds futures now assesses around 92% chance for a 25 base point cut in November FOMC meeting, but there is this mounting speculation that the Federal Reserve could actually make a pause to its nascent loosening monetary policy as soon as in December. As such, the US dollar index continues to recover across the board. The greenback is now offered this morning in Asia, but the US dollar index actually rallied more than 4% since a September dip. Then the euro dollar sold off to 107.61 level yesterday as the rate cut bets in the Eurozone remain strong, and they remain strong on the back of inflation that seems under control in the Eurozone, and due to the economic and corporate data that actually hint at suffering economic tissue in the Eurozone. In this respect, we hear many European Central Bank members will sound more dovish than not regarding the European Central Bank's next policy move. So Olli Rehn, for example, said that the Eurozone's dear economy may bolster disinflationary pressures and allow the ECB to cut Further, Bank of France's Francois Villeroy called for more agility with future interest rate cuts to avoid acting too slowly. And Mario Centeno said that the European Central Bank should actually consider ramping up monetary easing if the economic data backs such a move. And it looks like the economic data backs the move. And this visible divergence between the Fed and the ECB outlooks should actually continue to support a deeper sell-off in the Eurodollar in the medium run. And if that's not enough for you, analysts at Goldman Sachs say that the euro could lose up to 10% in case of a Donald Trump win in the US next month as a result of high global tariffs that could further hurt the European economies and the European companies and increase the chances of a stronger monetary support from the European Central Bank. As such, price rallies should meet resistance near the 108.70 level in the Eurodollar, which shelters the minor 23.6% Fibonacci retracement on September to October sell-off, and the pair should remain in the bearish trend below the 109.35 level, which is the major 38.2% Fibonacci retracement on that same sell-off. Elsewhere, the dollar yen cleared the 150 resistance, pulled out the 200-day moving average offers, and is trading past the 152 level this morning in Asia as the continuation of the rally that actually started with dovish remarks from the new Japanese PM, who actually suggested that the country doesn't need another interest rate hike this year, and today's data suggested the same thing. So the yen could need another FX intervention to stop it from falling too fast, too low, but we never know when. In Britain, cable slipped below the 100-day moving average and remains under a selling pressure this morning as the Bank of England's Bailey says that inflation in Britain is weakening faster than they anticipated. And in Canada, the loonie hit the lowest levels against the US dollar since the beginning of August after the Bank of Canada delivered a 50 basis point cut yesterday as expected by analysts. Now, there could be a certain easing of the US dollar rally at some point in time, but it seems unlikely before, the US election that's due at the beginning of November. In equities, European stocks remain under pressure. The rising dovish voices at the European Central Bank are obviously good news for investors, but the earnings season is not going particularly well for the European companies, unfortunately. So ASML announced last week, remember, quite weak results, and Deutsche Bank also warned this week against rising bad debt due to morose economic environment in the Eurozone, and also announced that it will set aside more money than expected before to deal with these soaring loans that are considered to be bad, while the European car and luxury stuff makers are under the pressure of weakening demand at home, especially for the car makers, and in China as well. So Hermes is due to report its quarterly earnings today, and it could reveal the slowest quarter in the past 3 years. A weakness that doesn't concern businesses across the Atlantic Ocean, mind you, because on the contrary, the US big banks announced a strong quarter when they reported their results earlier this month. TSM blew past expectations last week and think that the US chip makers have likely had a good quarter as well. Then Netflix did better than expected by analysts, and Tesla, which has been struggling lately, even they came up with better than expected results yesterday. After the closing bell, the company reported an 8% revenue growth in the third quarter and a 17% jump in its net income, said that their cost per vehicle were pulled down to the lowest levels ever, around $35,100 per vehicle. The operating margin got a boost from 7.6 to 10.8% since last year, and finally, the Cybertruck reached profitability for the very first time. So shares in Tesla jumped 12% in the after-hours trading, and the latter could eventually give a boost to the S&P 500 and Nasdaq 100 today after a few days of hesitation and retreat in these major indices. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.